Hello, investors and future investors. Welcome back to the channel. Have you ever wondered how successful option traders consistently keep choosing the right strike price? Well, I'm going to answer that and lots more in this video. And you guys know how we do. I will give you the complete walkthrough in order for you to be able to do this on your own. Welcome to Investment Gains. Let's jump right into it. Welcome back, investors. Now, I do not have to stress the importance of choosing the right strike price. The fact that you stumble on this video means you do know the importance of choosing the right strike price. Now, in today's video, we're going to cover a couple of things. The number one thing is we're going to go through what strike prices are and how exactly do we choose it. What we're going to do next is going to be the factors to consider when selecting that perfect strike price. And as usual, I will give you an example of how to choose your strike price using a couple of different strategies. So for today's video, we're going to be using Micron Technology, ticker MU. And you guys know how we do it. We're going to get down and dirty with options, meaning we're going to be doing the actual options trade. Okay, so here we are on Micron Technology. And to get started, we're going to go ahead and choose Trade MU options to your bottom right if you're using a desktop. Now we are on the MU option change. Now we're going to go ahead. I'm going to show you how to choose the perfect strike price. Now, before I do that, I need to explain a couple things for you. The first determinant factor, you need to decide what strategy you're trying to employ. The right strike price will be determinant on the strategy that you're using. So we're going to use as an example covered call option strategy as our first example. Now, with the covered call option strategy, you're going to go ahead to sell and call, and now you're going to look for that perfect strike price. Now, let's go ahead and let's change our date. It is Thanksgiving, so we're going to go just a couple of days further out to December 6th. Now, let's start off with the terminology. There's three strike prices that can be chosen. Yes, that's correct. Only three. You could choose the strike price at the money, in the money, or out of the money. Let's start with the easiest and most basic of them, which is going to be at the money. Now, as you can see here, MU is trading for 101.81. Now, if you're going to buy a strike price at the money, those strike prices is going to be 101 right here or 102. Now, the reason why they call at the money is simply because they're the closest strike prices to the current share price. So that's at the money strike prices. Now, the other strike price you can choose is what's called in the money. Now, in the money is going to be any strike price that's below the money and drops down further. So at the money is going to be 101. So any price 100 and moving downwards is going to be in the money. So here we are of in the money. So like I said, all these prices here are in the money. Now, the third strike price that can be chosen is what's called out of the money. Now, any strike price above the 102, remember the 102 is at the money. So any price above that is going to be out of the money. So as we continue to go up, you're going to see these are all out of the money strike prices. Now, I did say choosing the perfect strike price is determinant on the strategy you're employing. So what we're doing is an example using a covered call option strategy. So when using a covered call option strategy, it is highly advisable that you choose your strike price out of the money. Can you choose your strike price in the money? Hell yeah, you can. Will it be lucrative? Probably not. So here we are. We're going to choose our strike price out the money. Now, another factor that can be used in order for you to choose your strike price is going to be your chance of profitability, which I like to use, or most traders like to use what's called a delta. Now, if you are using Robinhood or any other of one of these option brokerage accounts, these up here can be switched over. So if you don't see a chance of profitability, feel free to go ahead and change it. Let me show you real quick how it's done. So I'm going to click into the edit pencil right here. I'm going to get that drop down. I'm going to scroll down until I see Delta. Where is that bad boy? Oh, right here. So I can switch it up to Delta, and there you have it. But like I said, I love using the chance of profitability. It just makes it easier for me. So let's go ahead and we're going to go ahead to chance of profitability, which I've been using since I've been trading options more than 10 years ago. At the 105 strike price, you see there's an 84% chance. If I switch it up to Delta, it should say anywhere between 10% to 18%. Let's just go ahead and just test that theory. So 84% chance, it should say 16 to 18% delta. So we're going to go to chance of profitability. We're going to hit the pencil icon, and now we're going to switch it up to our delta. So here we are on our delta. So let's get back into chance of profitability so we can continue the video from there. Okay, so once again, we're back on the chance of profitability. Now we're going to go ahead and choose that perfect strike price. Now that perfect strike price is going to be based on a couple things. The most important thing is going to be based on your risk tolerance and your option trading experience. Now, let me tell you about your risk tolerance. Now, for me, whenever I'm choosing a strike price, you doing a covered call option strategy, I like to look for a chance of profitability of around 80% or higher. Now, 80% or higher, I could close my eyes blindly and that would fit me perfectly. However, based on my option trading experience, I would know a stock like Micron Technology is a pretty stable stock, so I do not mind risking going to a 78% chance of profitability, which is still pretty much close to 80% chance of profitability. Now, what is the relationship between the strike price, the chance of profitability, and most importantly, your premium? Well, here it is. The higher your chance of profitability, that means the greater the chance of you winning this trade, then the lower your option premium will be. So at the 105 strike price, you can see that your option premium is going to be $32. If you were to take a higher risk and reduce your strike price to 104, which also reduces your chance of profitability, now your premium goes up by $20 and is now 0.52 or $52 in option terms. Now, if you're not much of a risk taker and you're going to move your strike price from 105 because you want to be super secure and you want to move it up to the 106 strike price, then what's going to happen is that your chance of profitability is going to increase to around 89%. But then look what happens to your premium. Your premium is now 0.19 or just $19. So the relationship between your price, your chance on profitability, and your premium is like this. The higher the strike price you choose, the lower your option premium is going to be. However, the higher the chance of profitability will be for you. And this works out for more conservative traders. Now, the reverse of that, the lower you choose your strike price, the lower your chance of profitability will be, but no risk, no reward. With that comes a higher premium, as you can see here. Now, we're going to switch over to a different option strategy. Let's go to the cash secured put. Now, if you made it to this video at this point in time, that means you've gotten some value. Here's my ask. Subscribe to the channel, hit the like button, but most importantly, if there's someone out there you know that's struggling with options and you think this video could help them out, feel free to share this video with them. And until the next video, keep pushing your investments.